Hello everyone! Welcome to the first real week of Liz Truss as our Prime Minister, with her brand new cabinet coming out in full force to bring us some brand new policy. And I'm going to waste no time but get right into it, because it has caused many quakes, especially within leftist circles and even with the actual economy. Of course, the things you will have seen will be nothing but bad news, but I'm here to tell you we need to look further into the medium to long term. Because really this is the economic equivalent of ripping off the band-aid for some short-term pain to give some long-term prosperity. It is the long-awaited economic track to finally get some free market back into the country. So let's get right into it. Mini Budget 2022 highlights a summary of the key points. So, as for those of you who don't know, there was a mini budget with Liz Truss coming in as the new Prime Minister with her new cabinet, and they did actually have some transformations to bring to the budget. So the first and biggest news of this budget were the taxes. The 45% top rate of income tax for those earning more than £150,000 is being scrapped. They will pay a higher rate of 40%, a 1p in the pound cut to the basic rate of income tax promised by Rishi Sunak for 2024 will be brought forward to 2023. The cut will cost the government £5 billion a year. There will be a 4-year transition period for gift aid relief to maintain the basic rate relief at 20% until April 2027 to support charities. In short, this is a massive cut to income tax, especially to those people on over £150,000. They are now paying 5% less tax, whereas the rest of us will be paying 1% less tax, which doesn't sound like a lot, but bear in mind with the alternative there were plans to increase all these taxes, though obviously not for the £150,000 and over tax band, because really that was put in as a trap laid by Gordon Brown, who in the last 3 months of his prime ministership introduced this tax rate as basically a trap for any Tory government who was going to take it out. It would be open season for the media to, and the leftists of course, to say, oh, they're just getting in to try and get their mates to line their pocket, which is one of the worst phrases I keep hearing, and I want to tax the bejesus out of anyone who uses it unironically. The threshold for stamp duty on house purchases has been raised from £125,000 to £250,000 from tonight. For first-time buyers, it will raise from a £300,000 threshold to £425,000. The value of the property on which first-time buyers can claim relief has been raised from £500,000 to £625,000. In short, they have made buying houses easier because stamp duty is essentially a tax you pay for moving house. Though for first-time buyers, obviously, they were generally exempt from this tax unless they were clearly rich and buying a ridiculously expensive house, which, to be fair, most houses in the country are now ridiculously expensive, hence they've raised that burden. The cap on bankers' bonuses has been scrapped. It was introduced under EU law in 2014, but the government believes that it limits London's competitiveness against financial rivals such as New York and Hong Kong. And not only that, all the bankers' bonus did was effectively move the bonus money onto their salaries. So their salaries just increased, and then there was no performance bonus that they could really give them. So instead you can perform as badly as you want as a banker and there will be no performance bonus, or your performance bonus will be the same because it's just in your salary. The planned rise in corporation tax from 19% to 25% from next April has been scrapped to support business investment. Reversing the increase will put $19 billion a year back into the economy and make the UK's corporation tax the lowest in the G20. It is an attempt to help stop Britain from appearing unattractive to businesses that might otherwise set up operations in the EU or the United States. Yes, because it is quite a thing for businesses to set up their operations in tax havens or other countries with low corporation tax, such as the Republic of Ireland, so that they can keep more of the money that they make. Onto the final bits of the tax cuts, a 1.25 percentage point increase in national insurance contributions introduced in April to help fund the health and social care will be cut from November. The health and social care levy has been scrapped. It will mean that 28 million people will get to keep an extra £330 a year on average in 2023 to 2024, and about 920,000 businesses will have a reduction in their national insurance bills. Alcohol duty will be frozen from February 2023. This is a tax cut worth £600 million and will save the consumer 7 pence on a pint of beer, or probably about £7,000 for me personally. 4 pence on a pint of cider, 38 pence on a bottle of wine and £1.35 on a bottle of spirits. A digital VAT-free shopping scheme will be introduced for international tourists outside of airports to support the retail and tourist sector. Not got too many comments on that last one, but the national insurance rise being scrapped and alcohol duty being frozen is a good indication of where the budget is going. Clearly Liz Truss is actually trying to keep her promise, which is quite surprising for any Prime Minister that I have seen in my lifetime. It does appear that her promise to cut taxes is being brought forward. In a sense, it is quite a Chad move to just walk straight in and go completely against the consensus of the G20 and pretty much every post-Keynesian economist that has been running the country since 2008, and even earlier, in fact. Next up is the topic of the day, obviously energy bills, because they've been rising non-stop for some months now. But energy bills for households will have been capped at an average of £2,500 a year for 2 years, a £1,000 saving at present energy prices. Bills have also been capped for 6 months for businesses, charities and public sector organisations such as schools and hospitals from October. An energy markets finance scheme will allow banks to be funded to provide emergency liquidity to energy traders. The cost of the energy measures will be £60 billion for 6 months in October. Or to put it in other words, the price has been capped and will be saving money for businesses, individuals and public sector organisations, and the rest of the money that will be owed to the energy companies will come from the public purse, which Liz Truss has said she will cover via borrowing, which is fine for short-termism. And I suppose with the energy prices rising to astronomical levels, you have to look a bit short-termism, especially for short-term politics like this. But what the government appear to be banking on is the Laffer curve, or the effect that lowering taxes will actually bring in tax revenue because people will have more money to spend in the economy, and then you get the tax there from VAT and other such movements of money such as investment or capital gains. Which, for those who are a fan of Thomas Sowell, will know that that is typically what happens. And not only that, but the government have a plan for growth, and obviously growing the economy will mean a growth in tax revenue. So, the government is aiming to achieve a trend growth rate of 2.5% for the UK economy. Legislation is to be introduced to accelerate the delivery of about 100 big infrastructure projects, including transport, energy and digital schemes, to reduce unnecessary bureaucracy in the system and to help drive growth. The government is in talks with 38 local and mayoral combined authority areas in England to set up new investment zones. The zones will offer targeted and time-limited tax cuts for businesses in an attempt to increase productivity and create jobs. Work will also begin with Scotland, Wales and Northern Ireland to agree zones in these locations. So, depending on what these big infrastructure projects are, if they're publicly funded or whether they're privately funded, that all depends on how much I support this. If it's all going to be publicly funded, absolutely not. If it's going to be to encourage private investment in these projects, that's absolutely fine with me. And the investment zones, again, seem like a good idea. Tax cuts for businesses in an attempt to increase productivity. I mean, they're time limited. I'd rather they were just completely cut, but there's only so much you can do in one budget. I-35 off-payroll working reforms have been scrapped in a boost for companies and contract workers. The reforms were introduced to stop so-called disguised employment, but hit lorry drivers and those working in IT. And this is actually one of the main reasons that we had a lack of lorry drivers, because they literally just couldn't get the jobs because the I-35 reforms were stopping them from doing so. Now that that's gone, we shouldn't have a bigger problem as we did. To limit the disruption caused by strike action, the government plans to introduce minimum service levels and a law to require unions to put pay offers to a member vote to ensure that strikes can only be called only once negotiations have genuinely broken down. Changes are being made to universal credit to encourage more people into work. This means about 120,000 more people who receive this benefit will have to meet regularly with their work coach, take steps to increase their earnings, and face benefit reductions if commitments aren't met. I have no issues with any of that. It stops people from getting universal credit when they're not really trying to look for jobs. And the less strikes we have, of course, the better, because it's making it quite a pain for me to get to Wales. So that's pretty much all the main points I wanted to go through with this budget. I am genuinely in the camp of this is unironically a good thing, and we are now going onto the right track for what a government should be doing with the economy, which is cutting taxes, cutting down government regulations, and making benefits harder to get. Obviously, I want them to go further and cut them even further and cut tax even further and cut regulation even further. But as I say, there's only so much you can do in the first real week of your government. And this is a view shared by Mark Littlewood of the IEA, who wrote for The Telegraph this week saying this is only the beginning of Kwasi's revolutionary new economic playbook. Further tax reductions and the largest rollback of red tape in generations has the potential to bring the fastest change since 1979, which is of course when Margaret Thatcher was voted in. In just 25 minutes on Friday morning, Kwasi Kwarteng completely reset the government's entire approach to economic strategy, which is something I've wanted since I got into politics. This may have been the shortest budget statement in living memory, but it is also the most dramatic. We may be on to our fourth Conservative-led government in just 12 years, but this administration is already unrecognisable from the three that preceded it. It has become an establishment tradition that the Chancellor is expected to produce a surprising rabbit from the hat in any such announcement, but as one wag put it to me, Kwasi Kwarteng appeared to have more rabbits than Watership Down. Many pundits and analysts seem to find the sweeping tax cuts breathtaking in their audacity. They should brace themselves for more of the same. This appears to only amount to the first baby step in an all-encompassing, no-compromise dash for growth. And I know there will be people in my audience that will roll their eyes at, we're going to have growth at all costs and things like that. But really, if you're cutting taxes and cutting regulation, what you're doing there is actually making it easier for the economic growth of companies, businesses, and individuals from outside the cartels that are lobbying for higher government taxes and higher regulations, such as Google, Amazon, and other big multinational companies that enjoy raising the taxes in countries because it allows them to carry on with their business with less competition. And really, we are overdue growth for businesses outside of that, because especially after the pandemic, that all shrunk after the 2008 crash. Everything got a lot more centralised. We've rarely seen any brand new companies come through and break the cartel that we see of Amazon, Apple, the companies I'm talking about, because you probably own a product from all of them. So this seems like genuine growth for the free market and will hopefully mean higher profits and higher paid work for those of us that want to get out of corporate multinational environments, such as myself. The first major break from the past is a shift to approach to tax in two key ways. First, to get the overall burden of taxation heading downwards. The general trend since 2008 has been for taxes to edge upwards. There has been no specific point where there was a giant leap forward. However, the ongoing ratchet effect has led us to the curious situation in which tax as a proportion of national income is at its highest level since the late 1940s. A strange legacy indeed of 12 years of Tory government. Even with the Kwarteng tax savings of £45 billion, the tax burden is still historically high, but the direction of travel is now downwards and is set to remain so for as long as this government holds office, which I am praying lasts for more than 2 years. The second key shift in tax policy is to pay little regard to distributional effects, which is another thing that I've been praying for forever, and we finally got it. Liz Truss and Kwasi Kwarteng accept and embrace the fact that any meaningful reduction in tax is bound to see the biggest cash gains accruing by those who pay the most tax. The motive behind changing tax policy, they would urge, should not be to show on a spreadsheet that less wealthy, lower salaried cohorts gain more than high-income households. That cannot be a sensible approach to economic policy. It would simply be using tax as a means of virtue signalling, i.e. that they are making the rich pay more because basically all of Labour want that. So the 45p tax rate and the cap on bankers' bonuses have been incinerated. Sure, doing so doesn't put pounds immediately into the pockets of minimum wage workers, but that's not the specific aim of such a move. It's to shift the UK economy into a more growth-orientated direction. Overall then, we can expect to move towards a tax system that is both lower and flatter, a sharp reverse in trajectory of the past 15 years. And this is another point. It's making all the leftists go mad and say this is a return to trickle-down economics, which we never had in the first place. Trickle-down economics is nothing more than a strawman argument. No one advocates for trickle-down economics, no one wants trickle-down economics. Trickle-down economics doesn't even exist. This is just a fallacy from basically everyone who believes this and pushes the idea of trickle-down economics being what free marketers want. It is a fallacy because they believe that essentially the GDP or the amount of money in the world is fixed. It's zero sum. Either the top 1% get everything and then none of it comes down, when really what this economic plan will do is make everyone's rate of growth increase. And yes, the people at the top, it will probably increase more than those below them, economically speaking. But as Margaret Thatcher put perfectly for everyone against this idea...
But what the honourable member is saying is that he would rather the poor were poorer, provided the rich were less rich. That way you will never create the wealth for better social services as we have.
Yes, it's amazing what people say when they're not particularly self-reflective about the things that they say, but hey, I don't think we're ever going to get out of this, so just keep pushing the positive vision of, yes, you can increase your material wealth, which is obviously what you want. It's just the natural human condition. It's like everything in nature. It just wants to be as comfortable as possible, which, when translated scientifically, means they want to waste as little energy as possible. It's exactly why chemical reactions occur. But anyway, the article finishes off. In retrospect, the mini-budget could be seen as merely the first move in a much wider and most intrepid game of economic chess. Further tax reductions will be accompanied by the largest rollback of state bureaucracy in generations. Truss and Kwarteng are going to need vast reserves of courage, patience and determination, alongside several dollops of luck. If they have them all, we could already be in the early days of the fastest and most wide-ranging British Revolution since 1979, which is exactly what I am hoping for. So as mentioned before, this is a radical shift in the paradigm of the economics of government. Unfortunately, because it is such a shift, the media have naturally been pushing against it, with the Times, well, I should say even the Times, putting out a headline that doesn't exactly give the full context of what is going on. So, why is the pound so weak, and will it keep falling? The pound reached a record low against the dollar yesterday morning, down 4.9% to below $1.327, after Asian markets opened for the first time since the government's tax-cutting and borrowing bonanza was revealed. Investors are concerned about tax cuts funded by higher borrowing, the more so after Kwasi Kwarteng's weekend hint of further cuts. The pound recovered quickly but fell again to 1.0688 after the Bank of England said it would not act on rates until November at the earliest. Analysts at Deutsche Bank said the timing of the sell-off was a mystery because the cost of the Chancellor's proposals was expected. Perhaps it is the unabashed revival of trickle-down economics that had markets a little aghast. Anyone at any bank using the term trickle-down economics unironically needs to be kicked out. That is my personal opinion. They said in a research note, it goes against the economic orthodoxy and zeitgeist. As such, there is likely to be a credibility issue. I love it. I absolutely love it. It goes against the orthodoxy and zeitgeist that we have at the moment of economics, which, as we can see from everywhere, has absolutely stunted growth since 2008. And so Truss and Kwarteng's plan is to start moving towards a 1979 type revolution in economics, a la Margaret Thatcher, which led to one of the biggest spikes in growth in the 20th century for Britain. We have simply moved from the Keynesian consensus to what was 10 years of neoliberalism, and I'm using the term in a purely economic fashion. If you think neoliberalism means woke garbage, then you need to take a look at section 28. And now we have been in a paradigm of post-Keynesianism since the latest of 2008, but let's be fair, we were going into it way before that. I mean, the trains were nationalised in 2001. And you never know, we might have just witnessed one of the biggest economic revolutions in our time, and that's what's making a bit of market volatility. And in that case, it is making the pound drop. It's as simple as that. It's because it goes against what has been going on economically worldwide for the past decade and a half. So there's no reason to think that these markets won't recover, because they did in 1979 after Margaret Thatcher started putting in her reforms, though they probably weren't actually as radical as this because she tried to get inflation under control first. But yes, as we can see, the pound has been hit from what looks like the announcements from Kwasi Kwarteng's budget. However, the Times then immediately asks, is the pound doing worse than other currencies? The dollar has been strengthening this year after the Federal Reserve tightened monetary policy and promised to continue until inflation was tamed. Higher interest rates lead to higher demand for a currency, and the dollar has risen against almost every other currency this year. Okay, so every other currency has dropped compared to the dollar, which is what the pound has done as well. So it seems to be with every other currency. It has also benefited from safe haven status in uncertain times. In the past year, it has reached a 20-year high against key currencies, including the pound and the euro. The euro has suffered similar trading patterns to the pound in recent months, with investors driving it below parity with the dollar for the first time in 20 years. Markets are selling the euro in anticipation of a downturn on the continent this winter caused by gas prices and the need for homes and businesses to ration energy use. The European Central Bank has also been slower in raising interest rates than its rivals. In other words, no, the pound is not doing worse than other currencies. In fact, the fall of the pound seems completely consistent with the strengthening of the dollar. Yet, of course, every leftist is going to jump on the bandwagon and say, oh my god, Kwasi Kwarteng, he's caused a kamikaze, as the Twitter trend was going. Which, to be fair, is very funny, but basically not true. I mean, yeah, his plan is going against orthodoxy, as me, Mark Littlewood, and basically everyone else agrees with. But this isn't the reason for the falling pound. The falling pound is because of the strengthening dollar, and is consistent and probably even stronger than most other currencies compared to it. Especially after the bounce back, because, to be fair, if you look at this graph, there was clearly a time where the pound did spike downward, but as you can see, it recovered quite well, and in fact seems to be above where it was on Friday anyway. So obviously the pound seems to be doing alright despite market volatility. However, market volatility is something that needs to be addressed by central banks to make sure there is a steady rate of growth. So there is a statement from the Governor of the Bank of England, and it says, "The bank is monitoring developments in financial markets very closely in light of the significant repricing of financial assets. In recent weeks, the government has made a number of important announcements. The government's energy price guarantee will reduce the near-term peak in inflation. Last Friday, the government announced its growth plan, on which the Chancellor has provided further details in his statement today. I welcome the government's commitment to sustainable economic growth and to the role of the Office for Budget Responsibility in its assessment of prospects for the economy and public finances. The role of monetary policy is to ensure that demand does not get ahead of supply in a way that leads to more inflation over the medium term. As the MPC has made clear, it will make a full assessment at its next scheduled meeting of the impact on demand and inflation from the government's announcements and the fall in sterling and act accordingly. The MPC will not hesitate to change interest rates by as much as needed to return inflation to the 2% target sustainably in the medium term, in line with its remit." In other words, all that the Bank of England said there was, we are watching the situation and may act in future if we need to. And the main aim with that was to make sure the market's stabilised. But with an announcement like that, obviously it's not going to give much hope to everyone else. But this was part of Liz Truss's plan. Throughout her campaign, she was saying that she wants an interest rate rise. And she, instead of doing it by quantitative easing, or in other words, money printing with extra steps, she's instead doing it by just cutting taxes instead. Obviously relying on borrowing to fill in any gaps, which, as I've said, not a completely ideal situation, but this is the real world, and compromises like this have to be made. However, there is another issue with the borrowing, more than just it will increase government debt. It won't only increase government debt these days, but thanks to the gilts, or in other words, UK government bonds interest rates, we might see that the debt is actually going to cost them more than anticipated. Because as you can see, over the past year, the gilt rates for 30-year bonds were anywhere from 1% to about 3%, and they never really went above that. As you can see, if you get right to the end of the graph, that goes up to nearly 5%. And what that effectively means is, for every £100 of government bonds that is being borrowed from investors, that means over a 30-year period, every year the government will have to pay those investors 5% of that £100. So in this case, £5, which is quite a headache because a year ago, for every £100 it would have cost them £1.20. Now, this might be quite a headache for the government, but given that gas prices are already lowering and their deregulation and tax cutting will increase growth, this will mean more taxes, and so the increase in bonds that they need to pay off won't be too bad. And in 30 years' time, when these 30-year government bonds or gilts will need to be paid back in full, there should be more than enough money to pay back the money that was borrowed. It's also worth mentioning at this point that gilt rates before the 2008 crash were typically between about 4 and 5%, so historically this isn't that much to worry about. As mentioned by Deutsche Bank before, this is just unorthodoxy and not part of the zeitgeist of current economics. That by no means means that these steps and these reactions are a bad thing. As mentioned many times over, this is ripping the band-aid off. This is causing short-term problems to have medium to long-term solutions, which is something I've wanted a government to do for some time. However, given that ripping off a band-aid is incredibly painful, that might mean a visceral reaction from the electorate. So there is going to have to be some sort of political miracle for the Tories to become popular again after this. Labour are a whole 17 points ahead of the Tories at the moment. However, given it's Keir Starmer in charge, I'm sure he will do something that will screw up his popularity yet again. The Labour conference is going on. I wouldn't be surprised if there are more ridiculous things said than last year. But I won't get into that now. I do hope this video was very informative on what this new budget meant and how the reaction of the leftists is nothing short of overblown. The pound is fine and on trend with what was happening before, despite the little trough, well, it was more than a spike than a trough, but the little spike down in its value for about an hour on Monday morning. Gilts and interest rates are really what you need to be keeping your eye on. They will tell you a lot more about how this plan will go. Should interest rates stay low and gilt yields go up beyond 6%, we might be looking at trouble. But that's not happened yet, so we'll just have to wait and see. But as for now, that was everything I had for you today. So as usual, thank you very much for watching, and until next time, goodbye.